So, what is dollar cost averaging? And why wouldn't I just go buy a great tech stock? Well, let's talk about that in the next Wealth and Whiskey video. So welcome to Wealth and Whiskey. I'm Roger Kiger. I've been a financial planner for about 30 years, helping people build wealth and protect their legacies. So I've been around and seen a lot, which is why this is called Aged and Unfiltered. But Wealth and Whiskey is about sharing everything that's happening in the wealth management profession and investing in general. So we really like to take a look under the hood and talk about some things that sometimes might be uncomfortable. That's okay. And this week we need to talk about a tried and true strategy called dollar cost averaging. And in a nutshell, it's really pretty simple. It says that you're taking a fixed amount of money and investing it into whatever the investment is over some time period, rather than saying that you can pick a moment in time that is the right price to buy a stock or invest your money. So let's talk through that. I hear a lot of times people say, hey, I see this stock, it's at a good price, I should go buy that. Well, is it a good price? And what's it going to do tomorrow? Because maybe tomorrow it's up, maybe tomorrow it's down. Is it part of a trend? Is that just the price today? What's causing all that volatility in the stock? I don't know. It's hard to figure that out. So dollar cost averaging says if we're going to buy a stock or an index or a portfolio, let's take a fixed dollar amount and invest that every week or every month into that portfolio. So you're buying some share prices that might be a little higher. You're buying some share prices that might be a little lower. But the average share price you buy over 3 months or 6 months, or in the case of a 401k, that average price is going to be the best average possible and probably lower than somebody looking at a stock and that's on its way up and saying, hey, that stock's doing really well, let me buy it. Usually people buy it when it's high in that scenario. So dollar cost averaging is a great way to minimize risk because you're buying at all the different share prices. It manages the volatility because, again, it's almost impossible to determine when to buy something if you're doing a one-time purchase, right? So it lowers your average cost and really gets you a better price. Now, this is really best for 401ks and people that are investing every year. A little bit of money that goes in over a long time period, that is essentially what dollar cost averaging really is. You're buying the best share price as an average that you can ever get. Yeah, the price is going to go up and you wish you'd put it all in on the front end, or maybe the price is going to go down and then you're just buying more shares. So you have to let it work, let that volatility work for you with the dollar cost averaging. But essentially, dollar cost averaging is exactly the opposite of FOMO. What is that? Well, it's fear of missing out. I can't tell you how many times I have somebody come to me and say, that stock's doing really, really well. I need to invest in it. Well, maybe that's not the right time to invest in it. Maybe you should have invested a little bit along the way every month and been invested prior to it running up. But even if you want to invest in it while it is high, invest a little bit at a time over time so you get a better average price. Because FOMO and looking at the next great stock, and we've seen this especially after the age of these chip makers, NVIDIAs and Palantirs and Broadcoms and some of these tech companies have done so well. We've seen a lot of people say, well, I just want to be part of that, and what's the next cycle that I can get invested in? Well, if you're not careful, it causes what we call whipsaw. And I've seen this happen over and over again. What whipsaw really means is that people know and understand that investing in the stock market is a long-term philosophy. It's a long-term strategy. So they invest money and they invest money, and they watch the market go up, and they're fine with that until the market peaks and starts to come down a little bit, and they say, you know, Roger told me this is long term, I'm going to stay invested. And it comes down a little bit more. Well, I know this is going to happen. I know this is normal volatility. I'm in for the long term. And then it gets down below what you put into it. That's when people start to get itchy. And they start to say, you know, I'm not sure I have the stomach to lose money. And then they say, yep, just get me out. I'm going to get out of the market, and I'm going to wait until it gets better. Well, does it get better? When does it get better? I don't know. How do you know when to get back in? So people sell at a price that is below what they paid for some of the stocks or the portfolio. Now you have lost money, right? You don't get that back. So what I've seen happen, this whipsaw effect, means that they wait till the market turns. Maybe it's a month or 2 or 6 or a year or 2. And when the market starts to go back up, they're starting to feel a little bit better. But not ready yet because we lost money in the last time we did this. So let's wait till it gets high enough, and okay, now it's been performing well for a few weeks or a few months, or maybe a year or 2. I'm confident the market's going to keep doing well because it's done well for some time period. So let's get back in. So what'd you do? You lost the opportunity to make that upside, and you bought in at a high price again. Maybe it's the peak. Maybe it starts to do this again. So it's the whole theory of buying high and selling low, because the psychology of watching your money go up and down in value. People look at their statements and they say, I've lost X dollar amount. They don't look at it in terms of percentages, right? And right now is specifically important because an average stock market volatility over historically is 10% a year. For people to lose 10% on their statement seems like it really, really hurts. We just haven't seen that in a while, so people now are more used to making 15 or 20% every year, and they don't want to see that volatility. That volatility is okay, it's healthy, and it's part of the cycle. But you can't let that volatility force you to make irrational decisions, such as selling when the price is low because you think it's not going to come back, or buying when the price is high because you feel confident that the market's doing well now. This is where the dollar cost averaging comes in. Pick a strategy, keep doing that strategy regardless of where the market is, regardless of what the price is of whatever it is that you're buying, and you will definitely make more money, stay invested, minimize risk, manage that volatility, and buy all those stocks at a lower average cost. So dollar cost averaging versus fear of missing out, I mean, dollar cost averaging is going to win every single time. So I hope that helps a little bit. And if we can help you start your financial journey, by all means, download the link to the Legacy Blueprint below. We'd love to have you involved, and by all means, keep watching our videos and like and subscribe to our channel. I'm Roger Kiger. I really appreciate your time. We hope to see you again next time. Cheers.